Welcome to part 2 of my interview with Jeffrey Kennedy about the Elliott wave principle. Now, Jeffrey, sometimes it's possible to use a divergence between RSI, relative strength indicator, and price action to anticipate a coming change of trend. Could you explain that?
What's important is that divergence, bullish or bearish divergence, occurs in conjunction with a completed Elliott wave pattern, or, for example, a significant candlestick reversal pattern. For example, if you're looking at a price chart and you can count 5 waves up, waves 1, 2, 3, 4, and 5. If you look at your underlying momentum indicators, RSI, stochastic, MACD, or MACD histogram, and you do indeed see a bearish divergence developing on the price chart, and then I'll say perhaps on a daily chart level at that extreme of wave 5 of the impulsive wave count, on top of the bearish divergence, you have, say, for example, an evening star formation or a bearish engulfing pattern. All of that together really gives you a confident view that the market is indeed going to correct or at least or possibly stage a significant trend change. Looking at signals in and of themselves really mean very little. But when you combine these, or what I tend to recommend, take a very holistic approach to technical analysis, including the Elliott wave principle, it can really identify those high probability signals, or what I tend to refer to as trade setups, more clearly.
And what advice do you have for traders or investors who are new to the Elliott wave principle?
My approach is very simple. I tend to look at the weekly time frame to identify the trend of a market. Is the trend up or is the trend down? That's very, very helpful. I know it's a very simple step, but for me it's a very cornerstone approach, or it's a cornerstone to my approach, not only to analysis but also trading. And then on the daily chart level, I look for basic patterns. And these are the 5 foundational structures or patterns that we talked about initially. The impulse wave, the ending diagonal, the zigzag, the flat, and the triangle. I look for those structures. And from a trading perspective, what I tend to do is, in an uptrending market, I'm looking to buy pullbacks. In a downtrending market, I'm looking to sell bounces. So that being the case, my approach tends to be to look for an uptrending market as defined by the weekly chart level, move down to the daily time frame to identify very specific Elliott wave patterns, and then from there I'll move to the intraday chart level to identify ideally precise levels to trade against, where a good entry would be, where a good initial protective stop might be, and so on. Keep it simple. Don't lose sight of the forest through the trees.
I've often heard you say that one of the most valuable assets of the wave principle is that it lets you know when you're wrong. Could you explain this a bit?
Oh, absolutely. And this is a very, very valuable aspect of the Elliott wave principle. And it's provided by the rules and guidelines that the wave principle actually offers. For example, rules pertaining to impulse wave development are what I described earlier. Wave 2 cannot retrace more than 100% of wave 1. Wave 3 cannot be the shortest impulse wave of waves 1, 3, and 5. And wave 4 may never end in the price territory of wave 1. Those are rules, and we never break those rules. Okay, this is very important from a trading perspective. Say, for example, if you see a market that you believe is tracing out an initial wave 1 advance, and then we're pulling back correctively, you'll most logically identify that counter trend move as wave 2. Well, you know where you're clearly wrong in your analysis, and that is prices may never exceed or fall below the origin of wave 1. So there's your level. So for example, if we're looking at, say, XYZ stock, and prices move up from $100 a share to $110 a share, you're identifying that move as wave 1. Well, the point you're wrong is $100 a share. So if the market prints $99.99, that interpretation is wrong. That precision, being able to identify where you're wrong to the pip, tick, or penny in any market you're looking at, is extremely valuable.
Jeff, thanks for providing these valuable insights.
My pleasure, Aaron. Anytime.
Join Jeffrey Kennedy online for an intense 5-session course where he teaches you about the 4 elements he analyzes on a chart before he makes a trade. He walks you through his entire thought process and shows you how to apply his method to your trading. Reserve your seat now for Jeffrey's 4 Critical Elements of High Confidence Trading course. Classes begin May 11th.